Hello, everybody. This is Whitney Emmanuel with Strategic Visionaries, and I am here for your money smarts for the day. So what I wanted to talk to you about today are bonds, what role they play in your portfolio, and what alternatives there are to bonds and why you may want to consider that. So first point of discussion is, what is the difference between stocks and bonds? So a good portfolio has both. You want to be diversified between the two. The ratio between the two changes depending upon your risk tolerance. But the purpose of a stock in your portfolio is for appreciation. So you want it to grow and you want it to keep pace with inflation. If you do not have enough stocks or stock funds in your portfolio will not keep up with inflation and you will not have enough to retire on, or you still need it even when you are drawing income from your portfolio in retirement, because let's say you're retired for 30 years, you need it to keep pace with inflation. But then there are bonds. Bonds are known to be the safe haven of a portfolio. They do not grow as quickly as stocks because when you own a bond, you're not part owner of a company, whereas you are with a stock. It's a debt instrument. You are lending your money to a company or a country, and they are paying you interest for that. So you don't get to participate in the profit of a company when you're a bondholder. And so, but with bonds, they're safer. You don't see the same fluctuations that you see in the stock market when you hold more bonds. And so that's the value of holding bonds. Now, there are different ways to hold bonds. One alternative to holding a bond mutual fund or a bond exchange traded fund is actually just holding individual bonds. And the benefit of that is that you're not guaranteed the value of your investment if you hold a bond fund. And when interest rates rise, which we are in a very low interest rate environment right now, so interest rates will eventually rise. And when they do, bond prices go down. They have what's called an inverse relationship, interest rates and bond prices. So when bond prices go up, the bond prices will go down when the interest rates go up. And so with that said, what do? If you hold an individual bond, even though the value of your bond could go down if you were to sell it at that moment, if you hold it to term, you are actually guaranteed the value of your bond. And so let's say you buy a bond for $1,000, you're getting a $50 a year payment, and that's your interest payment. But let's say the value of your bond goes down to $950 and your interest payment goes up a little bit. That's usually what will happen. When you sell that bond, at the end of the term, you still get $1,000 guaranteed by the bond issuer. So the more financially secure the bond issuer, the better. And you can buy a portfolio of individual bonds. You can do that through unit investment trusts. You can do it through separately managed accounts, or you could create it yourself. That's pretty complicated, but you can do that. So that's one alternative. Instead of holding bond funds, you can buy them individually. The second alternative would be annuities. There are all different types of annuities. But a good alternative could be a fixed income annuity. It could be an indexed annuity. It could be just a fixed interest rate annuity, although interest rates are really low, so I'm finding that's not the best option, but that is an option. And so annuities are guaranteed not by the bond issuers, they're guaranteed by insurance companies, and insurance companies have to make good on their promises by contract. And so annuities could be a good option. They are guaranteed to pay you income for your lifetime. And so that's a great option. They cannot fluctuate in the market if they are fixed or if they have guaranteed rates on those. So that's a good option, depending upon, but the one negative of that is that they're not as liquid and flexible. So if you like flexibility and liquidity, then an annuity may not be a good thing to have all your money in, but potentially a portion of it. Then there are structured products. I've been using these a lot with my clients lately. So the one that I really like is a market-linked CD. It's FDIC insured, but you can participate in some of the market growth. So you kind of get the best of both worlds. There are, of course, fees associated with it. There's waiting periods that range from 1 year to 7 years, but it's a good option because, again, you get that guaranteed floor that's FDIC insured. So just like you would get bank insurance for your cash, you can insure these products, but then you get some market growth and participation, which I really like. So that's one. Third option could be life insurance. Now, I know a lot of people don't like insurance because you think, they only profit if something bad happens. But there's something called cash value that you can have in your life insurance policies, and that can oftentimes, depending upon the contract, can be guaranteed. And we like guarantees, right? That's why we hold bonds in the first place, to have some safety. So if you want to have guaranteed safety in a portfolio, you can do that through life insurance. And another secondary benefit of life insurance that some of these other vehicles don't have is that all of that cash value grows tax deferred in within the policy, and then also can be tax free in the future, which we are really looking at that as planners and advisors, because tax rates will likely go up in 2025 because that's when the current tax law sunsets. So that is another consideration, would be cash value life insurance. The guaranteed ones are indexed universal life policies or whole life policies. Both of those have guarantees associated with them. So those are just a few alternatives to bonds. There are some other vehicles that you can use to diversify your portfolio, but they don't have the same guarantees, such as alternative investments in real estate, private equity. But I wouldn't suggest that necessarily as a bond replacement if you're looking to have a safe place to put your money. But if you want the safety, some alternatives to those bonds are, as I mentioned, annuities. It could be holding individual bonds in investment vehicles like that, like unit investment trusts. And it could be cash value life insurance. So please let me know if you have questions or how that could fit into your own strategy. And I hope you have a beautiful day. Thanks so much. And that's Whitney Emmanuel with your Money Smarts for the day.